Hi guys, time for some learning unit 4, shall we? Yes, so let's start with the theory side of things first. So I'm going to explain to you the different types of costs that you can have, some examples of them, and then I'm going to move straight to break even, which is the second part of learning unit 4. Then obviously some worked examples via some questions, but that will be in 2 separate recordings. Right, so for now, let me share my screen with you. Just going to load up my notes. Right, here we go. So learning unit 4 starts off by explaining the different classes or categories of costs that can be experienced if a business is manufacturing. So I've decided to consolidate this and combine everything together right from the get-go to avoid any confusion, because the book is a little bit all over the place on this one. So our first main class of costs is known either as a product cost, alternatively a production cost, or lastly a manufacturing cost. All of those are just synonyms for exactly the same thing because the components thereof are exactly the same. So if we are talking a product cost, and I'm just going to refer to it as product cost, but you can also remember they may say sort these costs into production costs, or sort them into manufacturing costs, or sort them into product costs. So what are we looking for there? First up is direct material. So always identify the product because it helps it make more sense. Direct material is the majority of what the product is made from. So you're never going to find that you're going to have like 5, 6, 7, 10 examples of direct material, because then you've misunderstood the concept. Direct material are the main 1, 2, maximum possibly 3 materials that are used in the production of the product. Okay. Then we're going to have direct labor. These are the workers who are specifically directly involved in the production of the product, often referred to as touch labor because they are there, hands-on. They are operating the machines. They are using the equipment. Yeah. Then we have a third category that is called manufacturing overheads. So the criteria for this is that these costs are incurred in the factory. That's why they are known as product costs. And there are 3 things here. Indirect material, which are other products, materials, which are used in smaller amounts in the production of the finished good. Okay. Then we're going to have indirect labor. So these are workers who are in the factory and they are not directly involved in the actual production of the product. So for example, you can have a supervisor of the team of workers who is operating the machines. You can have cleaning staff in the factory. You can have somebody who is in charge of the stores in which we've got all of the components and the materials. You can have the security of the factory. The word I'm saying all the time, everyone, is factory. Right. Then the third category are any other expenses that relate directly to the factory. So here we can have some things like rent, electricity, water, insurance, maintenance, those sorts of things, where some of it possibly is paid because of the office and the rest is factory. So sometimes we are going to have to take a certain cost like rent and split it or apportion it between the factory and the office. So the bit that is for the factory is counted as a manufacturing overhead, therefore it is a product cost. The remaining bit for the Office is, however, a period cost, and in fact, it's an admin cost. Okay. Whether or not you should take some costs and split them depends entirely on how the question is worded. Okay. So a bit further down, I'm going to also say that another way to classify costs is into fixed or variable. And I will come back to this business here of splitting a cost, yes or no. So there we have the three components of product cost. Let's also take, for example, like the question in the textbook with depreciation. So you can't take an expense and just put it into a box and put the lid on and say depreciation is always and only ever a whatever kind of cost. It depends on what is depreciating. So if it is the depreciation of the machines that are in the factory producing the product, then that's an example of a manufacturing overhead because it's a factory expense. If it is depreciation of two other things, for example, office equipment, photocopiers, scanners, those kinds of things, or if it is depreciation of a delivery vehicle, that will not be considered a manufacturing overhead. So what could it be if it's not those? Our second major group of costs is either period cost, also known as non-production cost, or a non-manufacturing cost. These are subdivided into two categories. First up, we have admin costs, which are all of your office cost. So where I was talking, for example, about rent, the portion of the rent expense that is attributable to the office will be a period cost, and it will be an admin cost in particular. If we are looking at the security guards in the factory, indirect labor, manufacturing overhead. However, if the same company provides security staff to guard the office, then it's a period cost because it's an admin cost. Going then to depreciation. If it is depreciation of photocopiers, etc., it's a period cost and an admin cost. The second component of your period costs are marketing, distribution, and selling costs. Now, these are all of the costs associated in getting the product to the customer. And they consist of obviously marketing, advertising, transport, commission, railage, all of those things that get the product to the customer. So, for example, depreciation of the delivery vehicle. That would be a period cost because it is to do with distributing the product to the customer. So what is a typical kind of a question that you could get? You can get some transactions and it will say, sort these into period or product cost. It may even be more specific and say direct material, direct labor, manufacturing overhead, admin, marketing, distribution, and selling. So you really need to be clear on this as to which categories each of the costs fall into. Another way that we can distinguish between costs is on the basis of whether they are variable or fixed. So you have encountered these terms before when you did your economics. So a variable cost is one that varies or changes with what? The number of units produced or sold. So these are costs per unit. The more you produce or sell, the more of the variable costs you have. If you cut back on the number of units you produce or sell, so your variable costs will change. What then is a fixed cost? It is one that is not related to the level of production. So they are fixed and they do not change as units produced or sold change. So basically, it's not really a production cost. So if your units are 0, you still have a level of cost. And those costs remain at the same level irrespective of any change in the level of activity. It's very important that you can recognize whether a cost is fixed or variable, because once you've classified them like that, then you can continue and do a calculation which forms part of the other part of this unit, which is break-even analysis. Let's enlarge that for you. So you cannot begin a question on break-even until you have sorted your costs into fixed and variable. How else can we classify costs? They can either be controllable, meaning that the financial manager or the business has some degree of control over them. So therefore, they can be managed. They can be allowed to increase or decrease. So examples of those would be certain kinds of manufacturing costs, because you only incur these costs as a result of manufacturing, and you do have the power and the control over the manufacturing process. Then we also have those costs that are uncontrollable, which means that the business cannot alter those. So this refers to certain kinds of admin costs, to taxes, which are set amounts or certain percentages, as well as rates, because those are property taxes determined by local government, for example, business licenses as well, and rent, because that is a contract that you negotiate with the landlord. Then, two more kinds. What then is a sunk cost? Right. So it is one that has already been incurred. So it is a past or a historical cost. So any decision that you make now or in the future will not have any bearing on this particular kind of a cost. Finally, we have opportunity cost, once again referring back to economics, the sacrifice of the next best alternative whenever a choice is made. So we will do some questions and we will put into practice all of these things. So I also want to deal with the final part of the theoretical side, and that is to do with break even. Right, so going back again to economics. Don't hate me for this, okay, but it should also be old hat to you already. So we can have various scenarios in a business. I'll just explain my abbreviations for you. TR, total revenue. Seems to be typing with a delay, really annoying. Sorry. Just going backwards. TR is total revenue, whereas TC is total cost. So if the income from the sales is greater than all of the costs, and these are your fixed costs, your variable costs, any possible cost, then the business will be earning a profit. If, on the other hand, you have more costs in total than your revenue, you will have a loss. And then what we are looking at here is the third one. If the total revenue and the total costs are exactly the same, the business is making neither profit nor loss because it is broken even. So the profit will equal zero. We can find this point in two ways. We can either do our break-even units, and that would be the number of units of a product that a firm has to produce in order to just cover all of its costs. Or we could do break-even in a second way in terms of sales revenue. So out of all of the revenue that's earned from the sale of all of the products, how much of that do we need to cover the costs? Because the rest will be contributing to profit. So how do we get there? We have a formula to calculate each. I will just go down to the bottom here. Have a look at this one. This one is important. Our break-even units, what do we need to do? We take our total fixed cost, TFC, total fixed cost, and we divide that by marginal income per unit. So I just want to give you some alternative terminology for marginal income per unit, and that is contribution margin per unit. It means exactly the same thing. So marginal income per unit or contribution margin per unit are one and the same thing. Okay. How do we calculate that? Over here. Here is my marginal income per unit. So it is the difference between your sales and your variable cost per unit. So that's why I say the first thing you do in a break-even question is you sort your costs into those that are fixed and those that are variable. If you have total variable cost for all production, you would obviously divide by the units, because here we want to have the variable cost per unit. And then we need to subtract that from the sales. Sales is basically just your selling price per unit. And that selling price per unit must be excluding VAT. And as you know, VAT at the moment is still 15%. It is not going up in this fiscal year. Okay. So to calculate your contribution or the marginal income per unit, all you do is you take your selling price and you minus your variable cost per unit. We can also have a marginal income ratio, and I will be using this concept in the calculation for break even. So what is the difference between marginal income and marginal income ratio? It simply is your marginal income as a percentage of your sales. So let me put that in my simpler language. It's your marginal income divided by your selling price times 100 to get it into a percentage. Okay. It's also known as the contribution margin ratio. And how would we calculate that? It would be the contribution margin per unit divided by the selling price per unit times 100. But don't get confused here. Just a reminder, contribution margin and marginal income are the same. Something else we can calculate is marginal cost. So this is the extra cost of producing an extra unit, as you have always understood it in economics. So it is a cost that's going to change as your level of output changes. So basically, it is just variable cost. Change in total cost divided by change in units. We can transform that into a marginal cost ratio by simply finding the marginal cost as a percentage of selling price. Prefer to say selling price instead of sales. Okay. There are some other concepts which are defined at the beginning of the section in the book. I don't think we need to really have a look at those. I want to focus on the main ones. Then, once we have calculated our break-even units, the next thing we can do is go and carry on and find this. Our break-even sales revenue. Over here. There are two ways to do this. If possible, use the simpler way. So if we have just worked out our break-even units above, we're going to take those and we're going to multiply them by the selling price, because after all, we have those units and we're going to sell them. So this here will be the simpler, more direct way of doing it. If, however, they didn't ask you to calculate the units, but you did go and do the marginal income ratio, then you can go directly from that to your break-even sales revenue. How? You will do this. You will take your total fixed cost and divide by marginal income ratio. You will get a slightly different answer because your break-even units over here, these ones, have been rounded up. And that gets me to a very important point. Sorry, it slipped my mind. We must make sure that when we do our break-even units, no matter what, we always round up. So even if it is just a small portion of a product that is being produced, we need to make sure that we have covered the cost of all of those costs. So if you get, for example, 25,8 units, you would always have known to round that up to 29. But what happens if you get 28,1 units? Still round up, always, always up. Then, a business is obviously wanting to make profit, not just to break even. That's, after all, why entrepreneurs take on the risk, because there's the potential for reward. So we can have a specified profit target, and we can calculate the number of units that the firm will need to produce in order to reach that profit target. All right. So there are two possible ways in which the question could be asked. The one that it must be in terms of when you do your calculation is this one. It must be a before tax profit target. All calculations are made exclusive of any tax. So that's why when we did our marginal income or the contribution margin, I did say that the selling price must be exclusive of VAT. And which tax are we talking about here? We're talking about company tax. And that company tax is equal to 27% of the profit. So make sure you know when to use VAT and when to use company tax. So a profit is subject to company tax. So if you do get it like that, nice and convenient, very easy, what do? You're just going to go and you're going to take that before tax amount of profit and you're going to add it on to the total fixed cost. So we'll do pretty much the same thing as we did in the break-even calculation. Only difference now is not only do we have the total fixed cost at the top of the calculation, but we add the profit target on. And once again, round up. What should we do in the event of them giving us profit target, but it is after tax? We need to convert it to before tax. So how will we do this? Shown you over here. Because the after-tax profit amounts to 100% less the 27%. I've just remembered over here, sorry, since I've made these notes. This would now, change. Let me just make a quick correction over here. For a long time, the company tax was 28%. It's now 27%. So once we've taken 27% off, how much are we left with? 73%. 73% as a decimal, 0.73. So here, where I put 0.72, please just remember to change that, should the need arise, and just use 0.73. And the rest of the calculation is the same. The book does go through a graphical analysis of break-even. Don't want to spend too much time on this because it's highly unlikely that they will ask you to solve graphically. Right. So if our scales are done neatly and accurately with values on them, we can then find the break-even point. If we just remember the basic concept, and which is that break-even occurs where total revenue and your total cost are equal to each other. So I will leave it to you to be able to understand the shapes of these lines. Notice here that they are all straight. Therefore, we assume a linear relationship between costs and units. The two important ones that we are looking at, total revenue, the turquoise line, and then the blue line, total cost. So at the point at which those lines intersect, which you can very clearly see as over there, that is your break-even point. Then when you've got your break-even point, you can come down to a neatly labeled quantity axis, and you can read off the number of break-even units. Similarly, we can go across horizontally to the other axis where we've got monetary amounts. We would be able to read off our break-even sales value. So that is it on the theory side of things. Going forward, I want to do one question where we're going to sort costs into product and period, and then secondly into fixed and variable, so that we can do a question on break even. So looking forward to that. Hope you are too. Bye for now.